CIO of Renaissance Investment Managers with me on the show. I'm speaking with Ajay Bagga, Chairman of Elements Platforms and Market Expert. Welcome to both of you and thank you so much for speaking with us this evening on ET Now. Pankaj, let me begin with your take. Is this a turn in the tide or a temporary reprieve?
Well, Tamanna, I firmly believe that we are in a new bull market. Effectively, post-COVID, we had a phenomenal bull market and markets have been in somewhat sort of a consolidation phase over the last 18 months from October 21 until, let's say, February of this year. And now I think markets, after having consolidated over such a long period of time, are making fresh moves. So I think it's pretty much I'm not surprised by this move. And I think it's pretty much in line with India's strong fundamentals and strong earnings growth that we're witnessing in this earnings season. And our view is that probably markets will make a new high before the end of this year. So I think we're in a new bull market.
Okay, that's a big statement there. Pankaj Murarka saying, I think we're in a new bull market. Ajay Bagga, do you share that optimism?
No, I agree with Pankaj to the extent that the Indian macros are very good, our corporate earnings are good, and our markets on a standalone basis should outperform. Valuations have also come down, flows have returned. So all those are factors helping the markets. But the big is the US market. I don't think this cycle's bottom has been made. The Jan 2022 to now a cycle for the US market, we have to see one firm bottom formation happening. And that has to be still made, and that will impact Indian markets, unfortunately, no matter how intrinsically sound, how fundamentally sound we are, or how much flows we are getting. At that time, we will get affected. So I remain cautious, Tamanna, on the markets. I am not so optimistic. I see multiple headwinds globally from US credit, US commercial real estate, how that gets resolved, the banking issues in the US, the point of pause and the point of pivot for the Fed, and the non-decline in the US inflation. So that's not going to allow the Fed to cut rates as fast as the markets are factoring in. Markets are today factoring in 50 to 75 basis point rate cuts in the US by December. That will mean a very strong fall in the US economy, which will engender the Fed to come to the rescue. The Fed's hands might be tied if the inflation has not come nearer to their targets by that time. So it's not that simple. Markets are confusing right now. Standalone Indian markets, very good. LinkedIn Indian markets, I'm not so sure.
A lot of it seems to depend on the mood of global markets as well. Just a follow-up here to Ajay. FIIs are back, seems to be the theme. Do you agree with that reading, and are they here to stay is the question?
Again, two things in this. Yes, in this financial year, we have seen 22,000 crores and plus coming into the Indian markets on a net basis. So they are back. Second, the Chinese upsurge, which we saw from October last year, and then at the opening of the COVID restrictions, that kind of enthusiasm is waning. The Chinese market is underperforming. So hopefully we'll get some amount of those flows also coming. But the big issue is the impact of the FIIs has been lessening thanks to the domestic flows, especially the SIP flows, which have reached 14,000 crores a month. The domestic flows are reducing the importance of the FIIs. We could see a period of nearly 15 months of FI outflows with 2 or 3 months in the center where we saw net inflows. But overall, we saw till about February of this year outflows, significant outflows from FIIs, and the market's held its own. Normally, in the past, the market, say 6 years, 10 years back, would have cracked quite a bit with these kind of FII outflows. But we held our own thanks to the SIP inflows that we are getting and the overall DII inflows through EPFO and all the insurance and mutual fund flows. So that is helping us. The impact of FIIs will keep reducing, and the DII flows will increase. That's a big positive for the Indian markets.
Pankaj Murarka, another big factor seems to be crude prices cooling off. And while it's being looked at as a sign of perhaps a slowing down in economic activity, obviously for us as huge importers of crude, it's good news. Again, is that enough and is that sustainable?
Well, you're right, Tamanna. Crude is a very big swing factor as far as Indian economy is concerned because being the second largest energy consumer and given that 90% of our energy requirements are imported, they have a significant bearing on India's economy, both from a macroeconomic fundamentals point of view and on the consumer side as well. The fact remains that crude prices have softened, and plus India, in addition to that, India has been a beneficiary of buying crudes at somewhat lower prices from Russia, given the ongoing turmoil, and that has really helped. But I think more importantly, just from the previous point on concerns on US and all of that, in my 25 years of investing, Tamanna, I've never come across any period when there's been nothing to be worried about. At any point of time, you'll always have some concerns. Now at this point of time, you have a turmoil in Russia and Ukraine. Some point of time it will be Taiwan. Some point of time it will be Iran. Some point of time you'll have an economic crisis, and some point of time you'll have a financial crisis. As we say in financial markets, markets are climbing the wall of worries. As long as there are worries, there will be bull markets. More importantly, I think from a foreign investor's perspective, in my interaction with many of the foreign investors, especially in the last year or so, what I tend to realize is foreign investors started acknowledging India as a standalone market, which is a separate market by itself, and they don't club India or paint India with the same brush as they paint every other emerging markets. Long while there was a very famous term coined which was called BRICS, which essentially represented the 4 fastest growing economies in emerging markets. And if you look around, today most of those economies are not around. China has become uninvestable from foreign investors' point of view, given their corporate governance, government interference, and what they've done with their COVID. Russia has become untouchable. Brazil is extremely commodity linked and interconnected, and they've had their own political turmoil. South Africa is too small economy for foreign investors or global investors to put any meaningful money. So the only economy for global investors chasing high growth economies is India. There is no other game in town. So I'm not surprised by the foreign flows that we're witnessing. In fact, I think it's my firm view, that the kind of foreign inflows that we'll witness this time around over the next, in this cycle, will be far, far higher than what we witnessed ever in India's history. And given the fact that while we are at a point where 60% of the world GDP is on the brink of recession, the fact is India is a standout economy, and probably now we are the fastest growing economy in the world. So we logically will keep on attracting more and more capital. So I think the underlying fundamentals of the Indian economy, both from a macro perspective or from a micro perspective, when you look at the corporate India, remains fairly strong. And the bull market or the rise in stock markets or indices that you're seeing are based on very sound fundamental underpinnings. So I remain very constructive or positive on the outlook for equities for India.
So how would you sort of implement that, Pankaj Murarka? You're saying that we're entering a new space of bull market, but clearly there are some performers, some sectors, some companies, some stocks which are performers, and the others are not. It's not a sort of a tide that lifts all boats. What looks interesting to you right now?
Well, financials in India has been doing exceedingly well because we are going through a period where credit cost in financial sector in India is at all-time cyclical lows that we haven't seen for a very long period of time. In fact, it's much lower than the long-term averages, and at the same time, the sector is a big beneficiary of rising rates because in a rising rate environment, banks tend to have pricing power and they tend to expand margins. So financial as a sector has done exceedingly well, and I think that will continue to do well. Apart from that, we've been seeing very strong signs of revival of India's investment cycle, and that's supported by one, continuing government investment into infrastructure projects, and more importantly, now we are seeing private sector participation as well. So the entire engineering capital goods sector continues to look pretty exciting, and these companies have been delivering very strong numbers with very strong order intakes and growth in the order book. So that looks pretty interesting. I think we've witnessed some sort of a cyclical slowdown in Indian consumption over the last couple of quarters, and that's partly because very steep price hikes or inflation that we witnessed last year. But I'm of the view that probably post good monsoon this year, and as we get into festival season, we'll see a strong revival in consumer spending as well. So consumer in India always remains a very long-term secular theme given our demographics and rising per capita income. So all of this looks pretty exciting to me.
Same question to you, Mr. Ajay Bagga. Consumption right now has not been the hottest, but the sort of rebound in financials, does that give you some comfort?
Yeah, absolutely. And, just building on what Pankaj said, I totally agree with these sectors also. Uh, I would add to that investors looking at India today, especially the domestic investors, we have to look at this economy going to a 5 trillion, 10 trillion economy, the markets rising to 5 trillion, 10 trillion kind of market cap. So you are well positioned within India. Within that, banking and financials will really be the funders of this growth. So take a 5-year, 10-year view and invest in India. I was talking more of the next 6 months. I'm very cautious still. I have been cautious last 18 months. And unfortunately, I've been proved right repeatedly. These skirmishes with 18,500, 600, the Nifty takes and then it retreats. So for it to break through, you need to have a strong global environment. It can't do it on its own. It's never done it on its own. We saw the same commentary in 2008 that we are different, we are decoupled. We know what happened. We saw it in 2013, 2015, 2019. It's not decoupled, it's very linked. We have to, I would say, next year or so, where the money can be made, financials, but it's a very well-known fact, more domestic than international kind of sectors, internationally linked kind of sectors. Domestic sectors will do better. This year will be challenging. I'm expecting RBI rate cuts also before the year end. We will see some slowdown. And the good news for India is that we will be in a better inflation scenario. We'll be under 5%, I'm expecting, over the next 6 months. And that will help the RBI to give us a rate cut towards the end of the year. That will be boosting the markets as well. The big risk comes from the external sector. That's the only thing which is not a big mark in India right now.
And that's been the theme for the last few years, actually. The external sector has been very unpredictable. But yes, rate cuts in India, cooling off inflation is something we can look forward to. Thank you so much, Pankaj Murarka and Ajay Bagga, for joining us on this discussion this evening on India Tonight. While we turn